Hi friends, welcome back to Stockwood channel, a channel where we discuss investing strategies with facts. Friends, as you may be aware that there is lot of volatility in the current market today, and because of this volatility, lot of stocks have hit a 52-week low, and because of which lot of retail investors have started to panic and stop buying more stocks in the current market, or also selling their existing stocks with losses. So there is lot of panic in the market, and some of the investors are even confused in what should be the strategy for investing in such volatile situation. So friends, in this kind of volatile situation, macroeconomics plays a very important role in investing in any asset class, and especially in equities. So in this video, I'm going to break this video into two parts. Basically, the first part I'll be talking about how an investor should invest in such a volatile situation, and what are the parameters that has to be considered for investing in stock market. And also I'll be taking you through one of the a report from a financial institute recommending what should be the strategy for retail investors to invest. In the second part, I'll be talking about three stocks which I'll be looking forward or tracking to invest in the coming days, which can give a good or a multi-bagger returns in mid or short term. So with this understanding, let us see what are the various factors that is playing out in the market today in the macroeconomics. All right. As you might be aware, the geopolitic tension is one of the major reason for this volatility in the market, and it seems like this political tensions will continue between Russia and Ukraine for a couple of more weeks, as I don't see there something happening in a very short period of time. The second is the high inflation market that the entire global markets are facing, be it the US market or the India market. Everywhere the inflation is at an all-time high. If you see the US market alone, the inflation annual inflation rate is almost about 7.5%, which is almost a 25 years high. And also in India, the CPI inflation has touched almost 6.5%. So in this kind of inflation market, there are certain strategies that the financial institute has recommended. We'll see about that further in this video. The third part is the quantitative tapering or tightening that the Federal Reserves have started. So to give a background about this particular aspect, friends, when the COVID pandemic hit the globe in 2020, the Federal Reserves in US started printing more and more currencies to bring a positive attitude in the market. This particular activity of printing more money is called quantitative easing. Now the pandemic has reached a stable situation. The Federal Reserves have taken a strategy to reduce printing of more money or even stop printing more money. Right? So this particular activity is called quantitative tapering or tightening. Amongst all this, what is positive in the current market is the India growth story. India being a big demography with a huge middle class population with an ability to purchase, and also this situation is improving every year, and also with a stable government at the central government with good policies being rolled out. This is a positive indicator in the whole scenario. So friends, before we get further into this video, a humble request to like and subscribe to my channel. This means a lot to me. Moving further, Morgan Stanley, which is the financial institute, has come out with a report about the investing strategies for retailers. So I'll be talking about some of the major points that has come out in this report, and also I'll be giving you a link to this particular report in the description box, which you can read through. And one of the main points that they have called out is, let me read it out to you, that is the balance of corporate fundamentals against the less accommodative US Federal Reserves would create a modest equity returns with opportunity for generating alpha. If I have to break this out for you, it means the balance sheet of most of the corporates are fundamentally good, but against the less accommodative US Federal Reserve policy, that is quantitative tapering and tightening being in place, the returns in this particular financial year for retail investors would be modest or comparatively less compared to the previous years. Right, in this cases, if you have invested in a good stock or a fundamentally strong stock at the right time, it can give you an alpha return, which means it can give a better returns than most of the indices like Nasdaq or Sensex or Nifty. Right, so going further into the report, they are talking about what are the value stocks and how to identify a value stocks. Right, if I read out again for you, we remain committed to a value. The first is that in a recession, value stock have tended to get very cheap. After recession, they tend to trade back to a normalized levels. They are not at that level yet. So what it means is some of the value stocks which are in a recession or in a volatile situation like this tend to get cheaper because there is a lot of selling pressures from the institutional investors. Right, and after the recession or once the volatile situation becomes normal, these come to the normal levels, which will actually benefit the investors who have invested at a lower valuations. Further, with this point on the value stock, they also see some of the inflation sensitive stocks are also getting hit by this volatile situation, and this can actually outperform in an extended period. So when they say inflation sensitive stocks, they are some of the stocks which are not related to our daily lives. Right, it may be in the entertainment sector or it may be in the automobile sector. So when there is a high inflation, the retailers or the usual consumers will tend to postpone their buying or investing in such luxury items like automobiles or holidays. Right, so these stocks, when the recession or the inflation is normalized, they tend to increase and then they'll give a better returns in a short or a medium term period. The third point that they are going to talk about is on the growth and technology stock. We are less negative on growth than we have been given the magnitude of recent underperformance versus the broad market. Recent underperformance, despite numerous impressive earnings report, mean many of these large cap stock names are now trading at a very reasonable valuation. So here the particular financial institution, that is the Morgan Stanley, is talking about some of the tech stocks in US like Amazon and Netflix, which have had given a very huge rally in the last 1 year, and currently they are taken a hit and are in a very good valuation, even though they have given a good earnings in the last couple of quarters. So these kind of stocks which has rallied a lot and given a hit are, they say that, are in a good or a reasonable valuation which investors can look for investing. So if I have to give a parallel to the Indian market, TCS, which is one of the IT tech company in India, which is given a good quarterly results, is actually trading at a reasonable valuation. So this is not a direct investing advice or a tip for investors. So the investors also have to look into other factors of such stocks. The fourth point is about they are asking investors to stop speculative buying, especially the stocks which are not fundamentally strong. So speculative buying, sometimes the investors tend to buy particular stocks thinking that a particular company is going to invest in a particular company, or it is going to have a merger with another company, or it is coming with the new products without proper announcement by the company itself. This is called as speculative buying, and investors are requested or advised not to make this kind of speculative buying in the stock market in the recent times. So with this understanding, let's move to the second part of the video. So in this part, I'll be talking about one stock in the infra sector and infra industry as a whole. If we see the how the infra industry is doing, the government of India has made various policies and investments related to infrastructure, mainly in the irrigation and housing and sanitation for all. And also some of the other policies or programs are like Amrut, which is aimed at providing basic civic amenities like water supply and sewage and urban transport to improve the quality of life in India. Right. If we see how the industry is doing over the last a couple of years, you can clearly see here that the PVC pipe sector industry, which was around 165 billion rupees in FY14, has reached up to 344 billion rupees in FY22. And further, with these programs having a good concentration or encouragement from the government of India, it is expected to touch 500 billion rupees by FY25. Further with this, if I have to pick one stock in the infra industry or the PVC pipe sector, there is one stock which is a mid cap or a small cap stock which was trading at around 150 rupees 3 years back, has jumped to almost 600 rupees in the current market. If we see the fundamentals of this particular stock, the sales have increased by less than two times of that of December 2018, from 361 crores to 664 crores. But this particular company is doing the business profitably, with the net profit increasing almost four times from 17 crores in December 2018 to 67 crores in the previous quarter. Also, if we see the P ratio of this particular company, it is trading below the median PE of 5 years, which is around 30 rupees to almost around 26 rupees currently. Further, if we see the shareholding pattern of this company is quite interesting. The FIIs have continuously increasing their share in this particular company from being around 0.65% in December 2019. Currently, it is around 4.84%. Also, some of the positives of this company is the company is debt free, and also it is expected to give a good quarter in the coming days. And also the profits have grown almost around 50% CAGR in the last 5 years. And also one of the important point in their annual report is they are expanding their manufacturing facility by bringing up their seventh manufacturing facility in Telangana, basically to improve or increase their market share in the southern part of the country. So the stock I'm talking about is Prince Pipe Systems. Right, if we have to see the PE ratio of this particular company against some of the market leaders in this industry like Supreme Industry, it is almost trading around the same PE or even less. Right, if you see the company Neil Kamal, the PE is around 29, and currently being a good profitable company, the PE ratio of Prince Pipes is lower than Neil Kamal Industries. Now let's move to the second stock. So the second stock which I'll be talking about now is a small IT company stock which has a market cap of only 2.6k crores, but have a good ROCE and ROE of 38% and 32%. It has three major service lines, one being the technology, where it caters to cloud and Salesforce implementation and IoT and testing services. The second and third being the automation and AI and design, where UI and UX are the major service offerings. If you see the company price chart, it has given almost a 5x returns in 1 year, from where it was trading about 50 rupees in the March last year to almost 300 rupees in January this year. If you see the sales and the profitability of this company, the sales has increased by less than two times of what it was in March 2019, but has the profit has increased near to three times from almost being around 12 crores to 33 crores currently. Also, if you see the shareholding pattern of this particular company, the FIS have started to invest in this company from the last two quarters. So in the coming quarters, we can expect more investment from FIS and DIS in this company. The company which I am talking about is R Systems. So if I have to compare the PE of this particular company against some of the other companies in the sector, it is at a decent valuation, being a good profitable company. The PE ratio of this particular company is 18.5, whereas some of the bigger companies are trading almost around the 42 to 52 PE ratios. And also, if you are interested in one of the multi-bagger stock in the IT sector, I have made a separate video. You can check that in the playlist. Moving to the third company which I'll be talking now will be about the blue chip company. This blue chip company has almost corrected around 22% in the last 3 months. Also, this company has positives like a company being debt free or reduced considerable debt in the recent time, and also is expected to give good quarters. So this company has also made a string of partnership and recent acquisitions in the field of green energy, that is in the solar panels, battery and hydrogen energy. Right, these new investments and partnership that the company has made is expected to give almost 10% of the company's profit in the next 5 years. Also, this company has three main businesses, which is oil and energy, digital, and retail. Yes, I know you would have guessed this company. The company is Reliance Industries. So, Reliance Industry being a blue chip company and being profitable for a long period of time has given only a ROE of 8% to the investors. But with the recent corrections, once the market recovers, this kind of company can give a good returns in short period of time once the market recovers. If you see the P ratio of this company for the last 5 years, when the sales has improved considerably, the P ratio is currently not at its peak and it is closer to its median PE of around 26. Friends, hope you like this video. If you like this video, please hit the thumbs up button and subscribe to my channel. Thank you.